Hey there, you ever stare at a price chart and it just looks like total chaos? Well, you are definitely not alone. Today we're going to try and decode the language of ICT trading. We're going to break down its core models into a simple, clear framework that can help you start reading the story the market is actually trying to tell you.
So, here's our game plan. First, we'll talk about decoding the market's language from this specific point of view. Then we'll get into the core building blocks. Think of it as the vocabulary you need to know. After that, we'll assemble those blocks into actual trading models, figure out how to validate an entry, and then wrap it all up with what actually gives a trader their edge. Let's dive in.
All right, first things first, we need to look at price a little differently. There's a reason so many traders are drawn to methodologies like ICT. They're looking for some kind of logic, a framework, in what can often feel like just random, chaotic noise.
And that really gets to the heart of it. It all boils down to this one question. What if all those squiggles on the chart aren't just noise? What if they mean something? The entire idea behind ICT is that big institutional trading leaves a footprint, a series of clues, and these concepts we're about to cover are designed to help you learn how to read them.
Okay, so before we can start building any kind of trading model, we have to learn the vocabulary. We got to know our pieces, right? Think of these next few concepts as our fundamental Lego bricks. Once you really get what each individual piece does, building the bigger structures becomes so much easier.
First up is the big one, liquidity. Honestly, you could argue this is the most important concept in the whole framework. It's seen as the literal fuel for the market, and it's not some abstract idea. We're talking about real orders. You've got buy-side liquidity, which is all the stop losses and buy orders sitting just above recent highs, and sell-side liquidity sitting right below the lows. The core idea is that price is deliberately driven toward these pools of orders. Why? Because the big institutions need to tap into that liquidity to fill their massive positions without causing the price to slip away from them.
Next on our list is displacement. Now, this isn't just any price move. We're talking about a powerful, sudden, really energetic shift. You'll see it on the chart as a series of big, full-bodied candles all rocketing in one direction. This is a huge signal that one side of the market has just taken complete, aggressive control. And crucially, this kind of move almost always leaves behind a little void in the market called a fair value gap, which is super important, and we'll come back to it.
And that leads us perfectly into our next piece, the order block. So, a bullish order block, for instance, is the very last down candle you see right before a huge decisive move up. This is seen as a major footprint of institutional activity. It's like a big red flag marking a spot where smart money likely placed a huge chunk of orders to kick off that move. And because of that, these blocks become really critical areas of interest that price might want to revisit later on.
Okay, we've got our vocabulary down: liquidity, displacement, and order blocks. Now for the fun part. Let's start putting these pieces together and see what kind of recognizable, high-probability trading models we can build.
So this is the classic, the foundational pattern, Model 1. Let's walk through it step by step. First, see how price dips down to perform a liquidity grab? It's taking out all those orders that were resting below that previous low. Then, boom, we get that powerful move up. That's our shift in market structure. That aggressive move leaves behind a fair value gap, our FVG, and the textbook setup is that you wait for price to come back and test that gap before it continues higher.
Now this is where it gets really cool, seeing that clean diagram play out on a messy, real-life chart. Take a close look here. You can see the dip below the lows. That's our liquidity grab. Then comes that aggressive push-up that breaks the prior high. That's our market structure shift. And see that little gap it left behind on the way up? That's the FVG. And look what happens. Price pulls right back into it before launching. I mean, it's a perfect example of the theory in practice.
Okay, now let's look at Model 2, which adds a bit of a curveball, something you really got to watch out for. It starts pretty much the same way, but notice this extra step. After that initial shift up, price makes a little dip to take out what's called inducement. Basically, it's grabbing some nearby, more obvious liquidity to fake people out before it returns to the real fair value gap. It's a slightly more complex variation, but man, is it complex?
And here's one more common pattern to keep in your toolbox: Model 4, often called the box setup. This one starts with price just chopping around sideways in a consolidation range. Then you get a sharp, nasty move down that grabs all the liquidity resting below the low of that range. The real key signal here is when price aggressively rips back up through that original consolidation box. That's a huge tell that the next major move is likely to the upside.
So now you can start spotting these patterns. That's awesome. But, and this is a huge but, just seeing a pattern isn't enough. That's only half the battle. The real skill is in learning to separate the high probability setups from the ones that are just going to fail. So let's talk about validating our entries.
This is such a great visual for validating an order block. Let's break it down. Look at the top example, the valid one. See that little bit of space, that imbalance right after the order block? That gap is what confirms the strength of the move. Now look at the bottom example. There's no gap. Price is just messy and overlapping. That makes it a much weaker, pretty much invalid signal.
All right, let's talk about a super common trap that so many traders fall into. You see price break a high, the market structure shift, and that fear of missing out, that FOMO, kicks in, right? So you jump into a trade immediately, but this is flagged as an invalid way to do it. So why is that?
And here's the postmortem. This is exactly why that trade failed. Let's look at what was missing. Where was the strong displacement? It wasn't there. The move up was weak. It was hesitant. And because of that, it didn't create a fair value gap. Without those essential building blocks, the setup was just incomplete and, well, it collapsed.
So what's the better way? What's the high probability play? It all comes down to patience. Here, we see the shift happen with strong displacement. This powerful move creates a clear, obvious fair value gap. The high probability entry isn't on that initial break. It's on the pullback into that FVG. You're trading the confirmed reaction, not just gambling on a prediction.
Okay, we've gone through the language, the building blocks, and the patterns. Let's tie this all together now. Let's summarize the core philosophy here. What is the actual edge that this framework is supposed to provide?
So if you take away anything today, let it be these key points. First, price is not random. It moves with purpose, and that purpose is to hunt for liquidity. Second, that big, aggressive displacement move, that's your confirmation that institutions are playing. The fair value gaps they leave behind become your best bet entry zones. But the real edge? It comes from waiting for all these signals to line up, the confluence, and then trading the reaction from those key levels, not just guessing what's going to happen next.
And that's really what this is all about. This isn't just a set of rules. It's a new lens to look at the market through. It's a way to start reading the story that price is telling you, minute by minute, day by day. So the question I'll leave you with is this. Now that you can start to see these patterns, where are you going to look for them next on your own charts?